gold goes up, those other asset categories beat gold. When that occurs, we'll have even more conviction that, in fact, the monetary metals have bottomed. And the good reason is what I've explained.
We are seeing gold and silver shoot higher. Silver is back above that $20 level. And in one of your recent reports, you talked about how a critical momentum level was broken on the upside, but we could actually be seeing precious metals fall from here. Your take on where we are right now in the metals markets?
We think you've made the low. Okay. First off, for gold, it's simply a third time down under 1,700 since March 2021, August 2021, and then again last month, where you found buyers. Now, nobody's talking about that. Everybody's talking about somebody conspiring to sell gold. But how come there are consistent buyers, regardless of the sentiment out there, keep buying at 1680, 1680, 1680. Now we're pushing 1770. Okay. I think that was the low. That was the third attempt to break through the bottom of a 2-year range, and I think it failed for the bears. Okay. That's a positive. Now, we know that gold miners and silver miners broke through those comparable lows of the last 2 years of floor, which is typical of them because they tend to be screaming babies, pardon me. They're attached to gold, but they're like children, and they scream. They go berserk on the upside more than gold, and they go berserk more than gold on the downside. So you have to keep that in mind when you're investing in gold miners or in silver. But if we've turned, and I think there's pretty good evidence initially here that we've turned sincerely off of a major low in gold, then these two other categories, silver and gold miners, will snap back in terms of the relative performance and outperform gold once again. So they're likely to be better places to be than actually in gold, but continue to watch gold. There are some other major events going on out there, technical and fundamental events. We all know that. The one that's not talked about much that we have focused on at MSA, and I urge your listeners to ask for a sample report on the website. When we send them, we don't bother you again. You get a free sample. But the weekend report we just issued sort of explains some of the issues I'm talking about here. The stock market move from the 2009 low to the 2021 high was the biggest bubble in stock market history of the United States in terms of percentage gain over a protracted period of time. The S&P went up 7-fold. Go back and compare that to the so-called dot-com bubble, where it only had tripled. Or go back to the 2007-9 high before the real estate collapse, where it had only doubled from its prior bear market low. We went up 7-fold in the S&P and 16-fold in the NASDAQ 100. So therefore, I've seen enough major bull market tops in the stock market, and we've called them fairly well in the history of 30 years of MSA, that I can label this one a bubble beyond any bubble we've ever seen. And therefore, the consequences of bubble breakage, especially in an asset category as big as the stock market, is that you'll feel real world effects. The average guy in the street will feel it. Corporations will feel it. Government income will feel it. There'll be all kinds of negative waves that come from this. Few people are talking about that bubble breaking. They're all talking about, well, since COVID, we've done this, or this metric is this, and unemployment looks good, and all this. They're not looking at the bigger picture of a bubble breaking of that size. When it comes undone, there will be wave effects that will hit those metrics that the Fed likes to look at. So we're pretty confident that the Fed becoming data sensitive, as they hinted at their last minutes that they released recently, they'll get data that will verify to them that, we better soften up here. We better back off this rate increase. We better focus the other way. And you can't just look at US markets, you got to look at Europe and Japan as well. And they're in trouble. If that's the case, and if the central banks have to go back to what they normally do, which is to say, print money to support their governments by buying their bonds, and to support other assets that they deem to be important, such as high yield corporate debt, municipal bonds, and buying US treasuries because, few other people want to buy them. Then what does that mean? It means they have to reverse policy back toward an inflationary trajectory, which is what's been going on for decades. It's a constant process. If you look at an M2 chart going back to the 1950s, it basically doubles the money supply every decade. The difference now is that over the last several years, it's been far more rapid than doubling. And if these events happen, if the bubble is breaking, as we claim, and it has real world impact on data points, data sensitive Fed again, then the Fed is going to suddenly back off. And as many economists are now mentioning, likely be dropping rates again next year. Well, here's gold, which is probably the most reflective asset on the planet in terms of reflecting the growth in the money supply. In other words, the degradation of money, gold offsets it. No other asset has done that. We've run charts on that recently that show the correlation between gold and M2 is far better than gold and commodity prices or gold in any other asset category. Then what is the Fed going to do if these data points start to flip negative rapidly? We know what they're going to do. I think gold knows what they're going to do. And I think that's why you have certain unnamed entities or major asset managers globally who consistently buy gold under 1,700 and have for the last year and a half. They know that the game that the Fed is trying to play will not play out. They'll have to reverse back to what their role is, to support government debt, hence increased money supply. So I think that's what gold knows, and I think the major asset managers know when they consistently keep buying gold under 1,700. Now, average investors don't seem to get that. They see the gold miners sink a lot more than gold on a percentage basis, and silver as well. But what they need to do is go back and measure the upturns and downturns in gold, and they'll see that when gold goes up, those other asset categories beat gold. And we do spread measurements of that. In our weekend report, we have an example of silver versus gold, which is on the verge of upside breakout. It was on a relative performance basis. When that occurs, we'll have even more conviction that, in fact, the monetary metals have bottomed. And the good reason is what I've explained.
I know we had you on a couple months ago. I think this was maybe like 5 months ago or somewhere around that time. And you had said that if the Fed reverses, what will happen this time is it won't be the stock market that reacts to it, the monetary inflation that the Fed will be creating, that will all go into precious metals. So can you expand on that? It seems like that's what you're saying is even if the Fed reverses at this time, the stock market will not react positively to that. The dollar will not react positively to that. No. We're going to see the money instead flow this time into precious metals.
It's always an issue over the years. And again, I've been around 48 years in the market since gold was legalized. I started working for E.F. Hutton, chairman of the COMEX I worked for. He was also head of Hutton's commodity division. So I'm intimate with the monetary metals. But Fed policy does not reverse trends that they create the bubbles, and when the bubbles break, they usually cannot, in fact, they cannot stop them. I don't know of an instance where we've had a bubble break, the dot-com or the real estate bubble in 2007 to 8, that they've come in and tried to defend and managed to stop it from happening. This happens to be the biggest bubble ever, meaning, what does it mean when you have a bubble? What it means is over a protracted period of time, the price action of a given market, especially it's as big as the stock market, influences people's decision-making about commitment of capital, assumptions about the future. And I'm not just talking individuals, but corporations, even governments. And when those assumptions are proven to be wrong, that means that errors that were built based upon those assumptions over years were wrong. And if you've made years worth of false assumptions, committed capital to it, committed all kinds of things to it, when it comes unwound, It's huge because the errors are compounded. They're not just over a 2-year period. They're a 12-year period we've had this bubble. So the error is too big. It can't be unwound. The main beneficiary we see again is the one that tends to replicate. In fact, it replicates the degradation of money. And that's what central banks do. Whenever they go the soft route, it means monetary growth occurs. Interest rates are driven to lower levels than a market would otherwise price them. And you have further errors created. And ultimately, it's the investors who take that river flow that the central banks create when they're panicked and direct it where they want, where the investors want it to go, not necessarily where the Fed wants it to go. So at the 2009 bear market low in stocks, for example, MSA went major bullish. In fact, the week prior to the low, we said the low would occur at a certain price, and it occurred there, and we were major bullish. That was because we thought it was the market had paid its dues, and the river flow of investment capital would go back into the market. This time, a new river flow will not go into the market. I think what the river flow is going into is what we see when gold gets under 1,700, under 1,700, under 1,700, 3 times since March of last year. Those are large asset managers putting the river flow that they anticipate, and that has already occurred, in fact, into what? An alternative asset other than the stock market. They don't trust asset values. They go into gold. And I think that will persist over the next couple of years in a fairly dramatic way, more than I've ever seen in my entire career, in fact.